Good morning, one and all. Today we're going to learn about financial reporting. So basically, financial reports. Why we need financial reporting? Because we want to know how the company is performing. So how we get to know that the company is in what manner their performance is, what is their position, what is their profitability. If we want to know that, we have to get to know that through a proper reports, and such a reports prepared by the institute or by any organization. We used to call it as financial reports. So financial reporting is basically refers to a system of preparing and submitting the corporate financial reports, disclosing the financial position and performance with the necessary details, notes, statements, and other information to different stakeholders. See, financial reporting, what we call it as, it's a system through which the financial reports will be prepared, and the financial report consists the information which is related to the company's financial position, company's performance, but giving details, giving the notes and the statements and other information which will be helpful to different stakeholders. So this entire process we used to call it as financial reporting. It's a system of preparing and submitting the reports which consists the details regarding the financial position and the performance, and communicating such information to the users. That is what we call financial reporting is. So what they communicate, what they disclose. So when it comes to the corporate financial reports, there we have mandatory disclosures and voluntary disclosures. Mandatory disclosure, these are compulsorily they have to disclose, like financial statements, directors reports, auditors report. But when it comes to voluntary disclosure, they are free to disclose, whether it depends on their wills and whims. If they wish, they can disclose, otherwise they are free to not to disclose even. So here we have the meaning of corporate financial reporting. It's a system of communication between the management and the users of financial statements in order to report the results of the business activities, and also demonstrate the credibility, accountability, and reliability of its working. So corporate financial reporting is basically a system of communication between management and the users. So it communicates the information regarding the business activities, regarding the credibility of the business, regarding how they are, to whom they are accountable, how they are, their information is reliable, regarding all those things. If they prepares the reports, that is what we call corporate financial reporting. So when it comes to the meaning and means definitions of financial reporting, corporate financial reporting, it has been defined by American Accounting Association. It defines that the financial reporting is the movement of information from private domain to public domain. That means the information which is there inside the company, that will be communicated to the users outside the company. That entire process we used to call as financial reporting. It is a process through which the company will communicate with the outside world. So through financial reporting only, a company will communicate their performance, will communicate the information to the outside world. Outside world could be anybody. So why exactly these financial reportings we need to prepare? What are the benefits of financial reporting? So financial reports are required by different parties because they have to take enough decisions. They have to take number of decisions, and their decisions depends on the information what has been communicated to them. So they require the decision. They require the information to make a decision. So that's why we need financial reporting, and financial reporting benefits a large number of users. It could be a shareholder, employee, it could be a creditor, it could be a bank, institution, government authorities. So all those parties need financial reports for various reasons. So as the financial reports serves those users, it is also called as a general purpose reports. So here we have the objectives and the benefits of financial reporting. So internal parties, why they need financial reporting, and external parties, why they need financial reporting, had been displayed here. And when it comes to the internal parties, they take up financial reporting in order to make managerial decisions, to plan their managerial activities, and to evaluate the performance of the company. So with the help of financial reporting only, they take decisions whether if the company is having profitable history, then they can go for expansion. like all those decisions they can take up, and they can plan whether to introduce a new product or the current product is having good sales. All these things they get to know through financial reporting, and by that they can evaluate the performance of each and every aspect. Either it could be a performance of employees, or it could be a performance of the resources which they are employing. So all these things are helpful through financial reporting. And when it comes to the external parties, why they need financial reporting? To decide whether to invest or not in the financial instruments. When they have financial reporting, through that they get to know how the company is performing, and based on that they can take up the decision. If they decided to invest, then how many, in what kind of security they have to invest, and for this also they need financial information. And apart from that, in order to revise their portfolio, in order to revise their investments, so they need financial reporting. And when it comes to the government and stock exchanges regulatory authorities, they also need financial reportings for their authoritative activities, like to rate, to give guidelines, to have a control over the business activities and all. They need financial reporting. So here I had quoted the corporate financial reporting. The benefits are why these reports have been required by external parties like investors, employees, suppliers. One by one we will see. When it comes to investors, why they need financial reporting? Basically, they want to make an investment. So they have to analyze the risk of their capital. They need to know how the company is performing. They need to know what is the returns that the company is providing on their investment. So all this information they get through financial reports. So they need financial reporting, and thereby they can take up the decisions whether to take an investment or not. When it comes to the employees, why they need financial reporting? Employees are working in an organization. They want to know the stability and the profitability of the company, because the payment of the salary depends largely on the profitability and the stability of the company. If such a information made available, then the employees can work in their organization satisfiedly. So that's why they need financial reports. When it comes to the suppliers and other trade creditors, they need financial reports, because they want to know the credit worthiness of the company, because they have supplied their goods on a credit basis. They want to know whether the company is capable to repay their amount. So that's why they need financial reports. Moving to the customers, why they need financial reports? Being a customer, if they are loyal to a particular company, they want to know whether the company will run for long. What is the longevity of the company, whether their product is available to them or not. So in order to get the information regarding that, they need obviously the financial reports. And when it comes to the government and other agencies, they need financial reporting for various reasons. Like taxation authority means they need financial information to charge tax. If other agencies, they need a SEBI, ICRA, ONICRA, next these are the agencies which give ratings to the companies based on their performance, and their performance is depicted in their financial report. So they need financial reporting. In general, public also need financial reporting. Public may consist of anybody, like students, like faculties, like research scholars. All they need financial reports for the purpose of like if a student, they want to know, they want to study the company's financial statements and all. So that's why they need. In the same manner, if the in general also the people want to know how the particular company is performing, what is the trend in their sales, what are the recent developments they have made. All these things they get to know through financial reports. So they need that. And when it comes to the lenders, they are interested in the information which enables them to identify whether the loans what they have given, that will be repaid, and the interest on that will be repaid on time. So in order to get to know that, they need financial reports. So here we have a Trueblood Report. So basically, a committee has been formulated in order to give suggestions regarding the objectives of a financial statement, and that committee have prepared one report which is named as Trueblood Report. It is chaired by Robert M. Trueblood during 1972, and by his name this report has been called. And the report has suggested few objectives of financial reports. So what is that? The basic objective of financial report is to provide information which is useful for economic decision. See, why we supply financial reports? In order to help the users to get the information which will enable them to take up right and appropriate decisions regarding investment. So that should be the objective of financial reports or financial statements. and to serve the primarily those users who have limited authority or ability or the resources to obtain the information who rely fully on financial statements as their principal source of information about an enterprise economic activity. See, financial statements are the only source through which one user who do not have the access to who do not have the power to access company itself on his or her own, so they rely totally on the financial statement. So such a financial statement should be made available to them. That is the another objective of financial statements. The next one is that to provide information which is useful to the investors for predicting, comparing and evaluating the potential cash flows to them in terms of amount, timing and related uncertainty. So when the financial statements have to be prepared, it should provide that information which will enable the investors to compare the company's performance, to evaluate the cash flows in the company, and thereby they evaluate the cash flows to them in terms of how much amount they can get, at what time they can get, and whether there is a chance of not getting their amount on time. All uncertain factors they can analyze through financial reports. That is the one more objective of financial statement recommended by Trueblood Report. So the next one suggestion is that to provide users with the information for predicting, comparing and evaluating the earning power of entity. So the financial statement should consist such a information which will enable the users to understand what to predict, to compare and to evaluate what is the earning power of the entity, how much the company is earning, whether they are in the trend of earning or that earnings have been increased over a period of time or not, that they can recognize here. And to provide information which is useful in judging management's ability to utilize the enterprise resources effectively in achieving primary goal of the enterprise as well. So when the financial statements has been supplied, then what happens, that financial statement should provide information which is useful in gauging the management ability. Judging the management ability means from the financial statement one should understand how well management is performing and whether the management is successful in using the resources of the enterprises optimally. That can be understood. And the next one is to provide factual and interpretative information which is useful for predictive purpose. See, the financial statement provide factual, that means correct, and interpretative means proper interpretation should be given which could be helpful to predict the future. So financial forecast should be provided when they enhance the reliability of users prediction. So financial, when the users can predict how the company will perform in future, no, then they can take up the decision. So that's why it should provide factual information. And when it comes to the government and non-profit organization, one of the important objective is to provide information which is useful for evaluating the effectiveness of management of resources. So when it comes to government and non-profit organization, they are accountable to many. So at that point of a time, these institutes have to give the information regarding how well they have managed the resources and how these resources helps them in achieving the goals. And finally, one more recommendation which has been suggested, which is to report on those activities of the enterprise which affect society, which can be determined and described or measured, and which are important to identify the role of the enterprise in its social environment status. So one of the important objective is to provide information regarding the company's performance and company's effect on the society, right? So a company, when a corporate performs, when a manufacturing unit or a business enterprises undertakes the manufacturing activity or a service activity, obviously they will harm the society because they make use of the resources which are available in the society. So from them, if there is any harm to the society, that has to be noted. And that is one of the important objective of financial statements, which is recommended by Trueblood Report. So the Trueblood report also presented a few qualities of a financial statements, and those are relevance and materiality, substance over form, reliability, freedom from bias, comparability, understandability, consistency. So what is relevance and materiality? So when the information of provided in the financial statement should be relevant and it should be material. Relevant in the sense what is needed, that information has to be given, and material in the sense the useful information should be provided, and the information usability differs from one to another. So that's why the financial statement should provide each and every information which is useful for individual users who are using the financial statements. Next one is substance over form. What is substance over form? So the name itself indicating substance is more important than formality. So substance is nothing but economic reality is more important than legal formality. So when you record the information, when you record the data or any kind of a accounting transaction, then economic substance given should be given priority than legal formality. Suppose if you had purchased one machine on an installment basis, and that machine will become the asset of the company after the payment of final installment, but in between if the accounting year ends, till that point of a time how much amount you had paid, no, that should be shown in the books of account. That is what economic substance is more important than legal formality. Then we have reliability. Reliable means again the required information has to be provided which do not give any scope for ambiguity. Next, freedom from bias. Freedom from bias means the information which is supplied in the financial statement, that should be free from bias. There should not be any misrepresentation or fraudulent information which has to be shown. So the financial statement should be free from misleading or misleading information should not be provided over there. That is what the freedom from bias. Next we have comparability. Comparability, when you provide information, the information should consist of that information should be in a form of comparison. Means when you use the same principles, same procedures in order to prepare your books of accounts, then those books of accounts can be compared over the years. So such a quality should be possessed by the financial statements. Understandability. So obviously the financial statements which have been prepared and presented should be in the form of understandable nature. They should be capable to understand how the financial statements have been prepared. And finally, consistency. So consistency in the sense the same procedures you have to use in your accounting what you have used over the years. Either it could be a horizontal consistency, vertical consistency, or um, third dimension consistency. So over the years you can use the same procedures between the financial statements, between the companies and the entities. If the same accounting procedures have been followed, that is what we call consistency. Next, one more report has been prepared which also recommend the objectives of financial statement, and the report is named as a Stamp report because it was chaired by Edward Stamp. He prepared this report in the books of namely Corporate Reporting, its Future Evolution. So this report is the Stamp report. It also gives four major objectives of financial report. So what are those financial statements objectives recommended by the Stamp report? First one, to provide useful information to all potential users of such information in a form and time frame that is relevant to their needs. So this Stamp report tells that the information what is provided to the users, that information should be in a proper form and in a proper time frame which is relevant to their needs, and to provide information to minimize uncertainty about the validity of information and to enable the users to make their own assessment of risk associated with the enterprise. So the financial statement should provide information which will reduce the uncertainty about the validity of the information. So the information should be authorized by the auditors. Then only we can believe that the information is valid, true, and this helps the users to assess the risk associated with the enterprises. And the next suggestion is that to develop the standards which will facilitate in governing the financial reports and providing a scope for innovation and evaluation of and improvements become feasible. which means this stamp report had suggested to develop standards which governs the financial reporting, means how financial reports should be prepared. Regarding that, few standards should be developed that is recommended by the stamp reporter. So right now we are having standards which tells how the financial statement should be prepared and presented, like Ind AS 1. All these are the all these developments are due to various committees which have recommended various aspects. Next, to be directed towards the needs of the users who are capable of comprehending a complete set of financial statements. So, this stamp report suggested that the financial statement should consist such a information which is needed by the users who can understand the complete set of financial statements. So, these are the four uh, objectives of financial reporting recommended by stamp report. Moving to qualities of financial information. So the financial information represents the information which is presented in the financial statements. To be useful to the users, this information should possess some qualities, and those qualities have been specified by generally accepted accounting principles and accounting qualities, and the qualities recommended by those institutes should be possessed by the financial information have been shown here. Look at the qualities of financial information. It should be relevant, it should be material, it should have faithful presentation of information, it should facilitate comparability, it should facilitate verifiability, it should be timely made available, and it should be made available in the understandable form. These are the few qualities of financial information. So the qualities of financial information consist relevance. Relevance means, as I already said, that the information should be made available to the users, which is related, which is required by them, and which is related to their financial decisions. And material means useful information has to be communicated to them. And faithful representation presentation means the complete fair information has to be provided. Comparability ensures that you need to provide the information which facilitates the comparison. Verifiability means the information should be in such a manner which can be verifiable easily, means it should be backed by the evidences and all. And the qualities, one more is that timeliness, means the information should be made available within proper time and proper form, and it should be in understandable form. So these are the qualities of financial information which has to be included in the financial information.